Welcome, everybody, to Multifamily Report, market news, industry updates. This show's dedicated to you, the multifamily investor, to keep you up to speed on the news, current events, what's happening out there in the world, and how specifically that pertains to multifamily as an asset class. I'm your host, Travis Watts. In today's episode, I have pulled a recent article produced by the Washington Post, and we're going to talk about the Federal Reserve, interest rates, and what we're seeing right now in the industry and how that impacts multifamily. So here recently, we just saw another 75 basis point rate hike. So the Fed funds rate has increased. And by the way, if you're not familiar with what that means, the Fed funds rate is essentially what banks have to pay in order to borrow money amongst themselves or to use for any purpose. So when you see a mortgage rate at 6%, for example, they're having to borrow at, let's say, 3%, and then they're having to place a premium on top of that in order to make a profit. And that's why mortgage rates are always more than the federal funds rate. So we have inflation still stagnating in the 8% annualized range. There's a lot of talk. There's a lot of speculation about the negative impacts and repercussions of these rising rates. So the question is, how far will the Fed take the rates? So mortgage rates have nearly doubled over the past year in single-family homes. Real estate's been slowing down. You're seeing houses sit longer on the market. In some markets, you're seeing price cuts start to happen. Developers are being hit on two different sides. They have higher carry costs when they're doing construction, supply chain issues, wages are increasing. And then, of course, they're having to look to the future at potentially higher rates, which is going to negatively impact the sale price of the new development projects. So it's quite a mess, but how does this affect the pre-existing multifamily sector? So let's talk about cash flow investing, which is what we focus on here at Ashcroft Capital. The properties that we purchase are pre-existing 1990s, early 2000s built product. They already have renters in place. So if we're going to go out and get debt or a loan on a property, which we commonly do, we're either going to look for fixed rate debt at whatever the rates are today and for a longer anticipated term than what we intend on holding the property for. If we go with an adjustable rate loan, we will typically buy an interest rate cap. For example, if we have a 5% mortgage rate today, we buy an interest rate cap at, let's say, 6. And if the Fed decides interest rates are going to go up to 9, well, we're capped out at 6. We're not going to have to adjust up to 9%. And oftentimes we try to make our loans assumable to the next buyer. So many years down the road, when we're selling, that buyer can potentially take over our existing loan at a lower interest rate than whatever they might be in the future. So a couple things to keep in mind. Frankly, it doesn't matter in this case what interest rates do in the meantime, at least up until our loan matures, whether it's 7 years, 10 years into the future. And of course, I'm assuming that the renters continue paying the rents throughout the hold period. Secondly, if you focus on value add multifamily, which means you're taking a pre-existing multifamily apartment building, you're renovating and making it a better, safer place for people to live, you can often justify lifting the rents that are currently in place because of this. As rents continue to rise on a property, that adds to the net operating income or the overall profitability of the property. So we're somewhat in an equilibrium right now in terms of interest rates, because interest rates coming up is a negative impact, generally speaking, to your potential sales price. So that hurts. But if we have renters who are now paying more rent than they were a year ago, that is adding to our net operating income and profitability. So we're kind of equaling that out. And again, the Fed, if they decide to raise another 100 basis points or 1%, then hopefully our rents are coming up with the inflation and through our value add plan. So while we might be flat, so to speak, on a potential sales price, at least we have the element of monthly cash flow throughout the hold period as we hold these projects. Now, if rates for any reason decide to come back down because maybe the US enters into recession and the Fed tapers off and decides to cut rates again, we could potentially refinance these properties, which will help preserve the equity in them. If rates continue to be the same, then we have a good chance of being profitable in the long run throughout the hold period, assuming, of course, that we execute the business plan properly. And if rates continue rising, hopefully we can justify that with raising rents in the process to help offset that negative impact. So there's never any guarantee or promises when it comes to investing, but I think the key takeaway is that the odds can be stacked in your favor 2/3. In other words, if interest rates stay the same or come down, that would be in our favor. If rates continue rising, that would not be in our favor. So it's a 2/3 scenario. So you could think of it like Las Vegas. The odds are in the house's favor. So over the long run, statistically speaking, the house wins. And that's how I like to invest. Personally, in this case, having 2/3 odds is definitely in your favor. Again, with disclaimers, past performance not indicative of future returns. Anything can happen. Nobody knows the future, but at least something to think about as an analogy. So, how far will the Fed take the federal funds rate? It's a great question. I'm going to pull up this Washington Post article again and read you the snippet. The Fed's benchmark interest rate now sits between 3% and 3.25%, and officials expect it to cross 4% by the end of the year. So, you guys, what the Fed is looking for is solid evidence of inflation coming down. They've committed to reducing inflation to their benchmark of 2 to 2.5% national year over year inflation. What we've been seeing in recent months is 8 and 9% inflation, which is at 40-year highs. And the latest CPI read that we had, you can find this for yourself at bls.gov, search for CPI, is 8.3% annualized year over year inflation. So, one question that you might be wondering as an investor is if the US enters into a really bad recession, will the Fed reverse course and lower rates again? And it's a great question because, at the end of the day, the Fed really only has two things they can do, I guess three technically. They can raise rates, which slows the economy down, makes it harder on businesses and real estate prices. They can leave rates the same. That's the second option. Or number three, they can lower rates, which helps to stimulate the economy. It entices business owners and individuals to borrow more money, to go spend more money to, again, stimulate the economy. So if we enter into a really bad recession, it is possible the Fed could reverse course and lower rates. Nobody knows, but I'll pull this up for you because historically speaking, as you can see, the Fed usually lowers rates when we enter into recessions. You can see that here at the dot-com bust around 2000, 2008, 2009, great real estate recession, and the pandemic recession here in 2020 and 2021. But again, there's no guarantee of them doing that. Nobody has the answer. I'm certainly not an economist. I'm just sharing this data with you to help you make better decisions. So here's a funny thing I was thinking of. So think of this. As a nation, as the United States of America, we're holding nearly $31 trillion in national debt. So imagine, let's reframe this. Let's say you have a mortgage on your house for $31 trillion and your lender says, hey, no worries, we're just going to raise interest rates just 1%. Don't worry about it. Well, that's $310 billion in extra interest cost every single year. 310 billion with a B dollars. So again, the question is, how far realistically can the Fed raise rates? So circling back to the article here in the Washington Post, I want to read you this. It says, on future rate hikes, Fed officials penciled in another increase of 0.75% and 1/2 point hike for the two remaining meetings of this year. The projections also show rates climbing slightly next year before cuts in 2024. But Powell noted that the bank makes decisions one meeting at a time. No one knows with any certainty where the economy will be a year or more from now, he says. So as an investor, I want to leave you with a couple takeaways and thoughts as we conclude this episode. The first is that real estate investing, at least to us here at Ashcroft Capital, is a long term play. So even if we've temporarily peaked in terms of pricing, that also presents simultaneously an opportunity to buy at discounted rates on future properties. If you're a dollar cost average investor, like I am, and you're not trying to time the market, which statistically is very difficult to do, and your focus is on cash flow, I have good news. You may be able to weather the storm. Let me show you this really quick. So, looking back at the Great Recession of 2007 to 2009, unemployment nationwide was up around 10% nationally. Reports from Urban Institute show that from 2007 to 2018, delinquency rates hovered below 0.5% and at times were lower than 0.1% in multifamily apartments. Extremely low defaults support the strength of the asset class. So, a common emotional response that always comes up in times of volatility and recessions, and when you look at the public equity markets and things are quite crazy, is maybe I should sit out on the sidelines and wait out the storm. And I want to explain, number one, while that's a 50-50 gamble and nobody knows the answer to it, why it might not make sense to do that. So let's say I make a decision that for 2023 and 2024, I'm completely on the sidelines. I'm going to sit in cash. I'm going to try to buy at a discount later on. Well, let's say in the first scenario, I'm exactly correct. And we have a falling scenario in the market and everything's softening up. 2024 starts to turn around, and that's exactly when I get back in. Well, the first thing to think about with that scenario is, yes, I did avoid the pitfall, right? I did avoid the downturn. But guess what? I also lost out on any potential cash flow, passive income, or possibly equity gains in a 2-year time frame. That could have amounted to 10 or 30% in my overall portfolio. Who knows? Now, in scenario number two, let's say I didn't have my timing quite right. And a couple months from now, the Fed comes out and they say, we're going to lower interest rates again, and real estate starts to take off and boom again. Well, again, I've lost out on 2 years of sitting on the sidelines, and I've missed out on any potential equity and or cash flow gains throughout the hold period. So a couple things I want to leave you with as we wrap up is, number one, our team, we continue to conservatively underwrite the deals that we invest in. We are predicting that interest rates continue to rise as far as our underwriting is concerned. And we also predict a softening of the market in the future, again, as far as the underwriting is concerned. Now, hopefully, none of this stuff comes true and we end up being able to outperform our projections. But at least to be cautious and to be conservative, it's already fixed into the projections that you may be looking at. If you look at any deals we have now or in the future, just know that for a little bit of peace of mind. But once again, you must do your own due diligence. This is not construed as financial advice. I'm not telling you or anyone else what to do. It's educational and informational purposes only. Past performance, not indicative of future results, but hopefully some food for thought, some things to think about as you grapple with the markets that we see today here in 2022. I want to sincerely thank you for tuning in to this episode of Multifamily Report. This is market news. This is industry insights. This is information for you, the multifamily investor, to know what's going on and how multifamily is being affected. I'm your host, Travis Watts. If you have any questions, you can reach me at travis@ashcroftcapital.com. Thanks for watching.